Hi, and welcome to Dollars and Making Sense, a weekly program about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. I'm always pleased to return to the microphone Frank Drenth from the Institute of Financial Professionals Australia. I almost said financial planners then, Frank, but it's not.
No,
You
not
do.
quite.
You do have planners as well these days, but you are
We do, we
financial
do.
professionals. Now, Frank, by the way, ladies and gentlemen, is an expert in tax. And I know some of you out there may not necessarily like talking about tax, but we've got great news for them, haven't we, Frank?
Well, going forward, there will be a tiny bit less of it to pay for people, and a wider range of people than was initially planned under the laws that were passed by the previous government.
So we are going to today, ladies and gentlemen, talk about the stage 3 tax cuts, and not just the quantum of those tax cuts, because we want to talk a little bit about that today as well, Frank. But this is stage 3. So there was stage 1 and stage 2. So sorry, question without notice, but can you quickly go over what stages 1 and 2 were for people just to refresh their memories?
Yeah, well, the major feature of the stage 1 and 2 was the low middle income rebates that fell away after a few years, and had a lot of accountants explaining to their clients why their refunds had shrunk. Because it wasn't strictly a tax measure. It was just the government giving people money and using the tax system to do it through. So people saw it coming through their tax. They saw it as a tax measure. So a lot of people saw the discontinuation of the tax offset as a tax increase. And strictly speaking, it isn't, but I can understand why people saw it that way.
Sure. And something, there's terminology that we used to have, LIMTO and LISTOs, they no longer apply, do they?
Right. The Lamington was the other term.
Lamington. Okay.
And that was disappointing for a lot of people because it gave them an extra 1,000 or more in their refund every year. Nice little way of saving up an amount which hasn't been repeated. And I mean, you can blame. The previous government had signalled it wasn't going to be extended, and the Labor government confirmed that. Everybody's blaming the Labor government for it, but whoever had won the 22 election would have discontinued it. So, blame your least favourite political party. It doesn't really matter. It would have happened anyway. And
move on. You get to extract retribution every 3 years, once every 3 years, I guess. In that regard, at the polling booth. So let's talk about the stage 3 tax cuts. A tax saving opportunities, what your article that we're going to actually refer to today. There's this great article, ladies and gentlemen. So if you go to the IFPA website, ifpa.com.au, the Institute of Financial Professionals. So legislation giving effect to the government's revised settings for stage 3 tax cuts have been passed by both houses of Parliament and have received royal assent. So they are LAW law, to quote an old politician's sayings, and that will come into effect on the 1st of July. So, Frank, do you want to go through those stage 3 tax cuts for the listeners?
It basically changes the thresholds and the rates. So the 18,200 tax-free threshold hasn't changed. That remains the same. But the 19%, which applied under the previous rules, has dropped to 16%. So you've got 16% right up to 45,000. Then from 45,000, you've got the previous rate of 32.5% going down to 30%. Now that's the same as the previous LAW, but where it changes is where the 37% comes in. It comes in at 120,000 now. The original stage 3 tax cuts were a lot more ambitious, and they would have left us with a 30% tax rate right up to 200,000. For a tax aficionado, that appealed to me because you've got this 30% rate, which is the same as the company tax rate, up to quite a high threshold. It means fewer people are going to be fiddling around with companies and trusts, because 30%
Okay.
is too bad.
That makes a good point. You make a very valid point there. And I guess it's a curiosity why the government didn't consider that a little bit more. But I think they were aiming to maybe, provide a tax, some tax relief right across the board, though, I guess. And at the top end, what's happening at the top end for the new tax scales?
Well, at the top end, the $180,000 rate, which was introduced by Peter Costello all those years ago, gets pushed up to 190,000. That was going to be 200,000 under the original stage 3, and that's where the 45% rate will come in. So if you're earning squillions, it doesn't make much difference. If you're earning 190,000 or more, your tax cut is worth about 4,500. Originally, it was going to be worth 9,000, and whoever was in government was always going to be up against it as the time drew near. Why are you giving $9,000 to CEOs and bugger all to people that are doing it tough?
Right.
Especially in the cost of living crisis. So it's not surprising, but we've still got a progressive tax system, which is important. So the tax you pay doesn't increase directly proportionally to how much income you earn. The rates increase with each bracket. So the more you earn, the more you pay. And when you want to give tax cuts to people, then you're looking at the reverse of a progressive tax system. And because high income people pay a lot of tax, they're going to get a bigger refund. Because people on less than 50,000 pay very little tax, and it's difficult to help them just through the tax system. We don't, because we've got the Social Security, the transfer system, and you should look at the tax system and the transfer system together when you're looking at things like income and wealth inequality.
Right. I guess one of the fascinating things when we're talking about tax scales, though, Frank, is that it ends up being a bit of a political discussion. And one of the things that got mentioned a lot, and I wanted to ask you in today's show, it gets mentioned a lot, not just by political commentators, but by politicians themselves. And one of the criticisms was talking about tax bracket creep. Can you explain to the listeners what bracket creep actually means?
Creep just means that as nominal wages go up through inflation, if you like, more and more of a person's tax income gets pushed over into higher tax brackets. So if the government doesn't do anything, and governments love not doing anything in relation to personal tax rates, then they're getting an automatic tax increase just by sitting on their hands.
So by doing nothing, in other words, inflation ends up pushing up the amount of tax that gets paid.
And then they give it back and they're heroes. But a really honest personal tax system would index the brackets, so that every time you had nominal wage increases that were in line with inflation, you wouldn't end up paying more tax. If you've got a promotion and you earn a lot more income, you pay more tax under the progressive tax system. That's how it's meant to be. But if you're standing still, why should you pay more tax?
It's a fascinating discussion, because I just recently had on the show one of your colleagues, Natasha Panagis, being an expert in superannuation. A lot of indexation is now occurring on the 1st of July around super, around contributions, around caps and the limits. And so with those going up, I guess it does kind of surprise. And I think, I'm just curious, when we're talking about policy and the like, I think it's something that's going to end up not necessarily in the short term, because we're due an election cycle in the next year or so, but hopefully in the next sort of election cycle after this next federal one, that we're going to have more robust debate around these tax scales and bracket creep, because you're absolutely right. If we've got an inflation rate and topical at the moment, for example, is HECS and indexation. It's not an interest increase that they keep on telling us. It's just indexation that's occurring here. but the poor old students, they're looking at their bill and going, well, hang on, it's going up. So that looks like an interest payment to me. So I guess one of those interesting things. So bracket creep is something that a government, as you've rightly said, Frank, if they do nothing, they get benefit. So do you think that's going to, sorry?
Yeah, well, you notice that when the government is owed money through HECS and HELP, they index the amounts so they're not out of pocket. Why don't they do the same with personal tax rates?
Yeah, I actually saw an interesting article just recently in The Guardian where they were talking. I think there are some crossbenchers now that are lobbying government to actually look at indexation in line with wage growth rather than inflation, so that if you are levying help and HECS against wages, why not actually then link it to wage growth? And I guess their argument is that certainly the last 10 years, wage growth has not kept pace with inflation in any way, shape, or form.
It's a very good point.
And I might point out, ladies and gentlemen, we're just about to go to a break, but Frank, I don't know if you follow any UK politics, but it's something that absolutely blew my mind. Ladies and gents out there in Australia, if you think you're doing it tough, the English wage earner has experienced the lowest wage growth since Napoleonic era. Now, I don't know whether The Guardian is accurate in this because I subscribe to The Guardian. I read them every day. But when I read this stat, I just about fell out of my chair. It's like, wow, for wages growth to be the slowest since the Napoleonic era is really quite a stat. Now, I guess
it's during a period of Conservative government too.
Oh, it's just one of those things when, again, when people are the people are out there sort of talking about cost of living crises, there are very valid data points out there that are pointing to this is not people just crying and whelping. This is fact. This is reality. And I've got 3 kids that all have HECS debts, and so they're looking later this year with trepidation because they're going to be indexed. This debt, and I guess we're going to need to step in sooner or later and do something. I guess we've got a budget coming up, and we'll wait and see. Look, we're just about time for a break. Frank, we're going to come back in a moment and talk about the title of your article, which is actually a tax saving opportunity. So we're going to get into some really interesting detail, ladies and gents, that Frank's written in his article about the kind of things we can be doing between now and 1 July to actually save some money. You're here on Dollars and Making Sense. Time for a break. We'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back. You're listening to Dollars and Making Sense. I'm Ray Treverson, and I'm here at the microphone with Frank Drenth, and he's with the Institute of Financial Professionals Australia, and Frank is a tax expert. Now, we've been talking about the new Stage 3 tax cuts that are legislated. They've been given royal assent, and so on the 1st of July, they will become LAW law. We love saying that because there was a previous Prime Minister that used to love saying that as well. Now, Frank, in your article that's on the IFPA website, I read it and it was like, wow, there's some really interesting things that can be done. And it's all about timing, isn't it?
Well, that's right. And you're looking at, you're choosing between the 22-23 year, the 23-24 year, which we're in currently, and the 24-25 year, which starts on 1 July.
Right.
And because there are tax cuts in the later year, in the 24-25 year, the opportunities come from shifting in shifting income from shifting income from this year into next year, and deductions from next year into this year.
Now, we're not talking about tax avoidance now. We're actually talking about everything that you're talking about in your article is perfectly legal. Okay, so let's work through some of these things. So your first one here is a permanent tax saving. So many taxpayers and their advisors focus on timing, year of end, deferring income, and bringing forward deductions. So what's this all about? What's the difference between previous timing things and what's going to happen now?
I mean, most people prefer to pay tax next year rather than this year.
Sure.
So since time immemorial, people have engaged in the time-honoured practice of bringing deductions forward and deferring income around 30 June. The problem with that, though, is that unless your income fluctuates, you're sort of standing still after the first year you did it.
Sure.
Because
it balances out, doesn't it? So
yeah.
you save 1 year, but next year it catches you up.
Right. So it reverses in year two, and you've got to do the same thing again at the end of year two. But because of the rate and threshold changes that are coming in with stage three, you're looking at some permanent savings. But I mean, permanent savings have always been available. Most of your listeners would be familiar with the practice of retiring in July rather than June. You've been working for the whole financial year, you've got a truckload of income, and there comes all your accrued leave and what have you on the week that you leave. It gets taxed. It can push you into a pretty high tax bracket. If it suits your employer and your partner, retire in July, and then from July you start using your super or going on the pension or a combination. You're not very taxable, and you pay a lot less tax on all that accrued leave and non-service leave and what have you.
So in fact, you're still earning the money, but instead of earning it in one tax year, by simply moving it from June 30 to 1 July, you're lumping it into the following tax year.
And also, if your income fluctuates, some businesses are more prone to that, farmers, some retailers, what have you. If you know that next year you're going to have a lot lower income than this year, then again, you look at shifting income out of this year into next year, and in reverse for the deductions. So that's all well-trodden ground.
So let's look at some specifics. You actually nominate some very good numbers here. How much can you actually save is in your article. So you highlight, without going into a whole lot of detail, but there's some specific sweet spots that you've pointed out where in certain tax salary ranges, they can actually save quite a decent amount of money, can't they?
Yeah, so for the $120,000 to $135,000 range, so you've got a 7% saving. You're going from 37% to 30%.
Right.
So if you're in that range, if you're at the top of that range, and you can reduce your 23-24 income by 15,000 and push it into 24-25, you save yourself just over $1,000. So it's not cheap stations, but it's not chicken feed either.
Well, I got to tell you, if somebody said to me, hey, just by moving a little bit of revenue from one side of the ledger to the other between 30 June and 1 July, I'm getting an extra $1,000, I wouldn't sneeze at that. That's for sure.
Yep. And it's the same thing, with a whole lot of areas. We'll start with income, because we're looking at income. If you're in business, you can hold up some of your June invoices, perhaps, depending on the legal and commercial situation, and also on the cash flow side of it. If you're paying deductible expenses earlier, or if you're holding off sending out an invoice, it's going to have a cash flow impact. You've got to think about that.
Sure.
As you try to get this tax benefit.
So I might just read from your article. It says here, to make certain you stay on the right side of the tax rules, you should check with your tax advisor before taking action. Now, obviously, IFPA represents, I think, well over 4,000 tax agents around Australia. And so from that perspective, ladies and gents, if you're not sure, obviously go back and talk to your tax professional. But as I said to you when we came back from our break, we're not talking about doing anything illegal here. All we're doing is timing certain transactions that would normally happen in one part of the year to a different part of the year, so that we take advantage of the fact that in this financial year, we're paying a high rate of tax compared to 1 July in the next financial year, we will be paying a lower rate of tax in the various tax brackets. Now,
but there is this rider in the article that you mentioned where I warn people about the general anti-avoidance rules. So if you get a bit too enthusiastic, you hold up your invoicing for 6 months. That's starting to raise a few eyebrows in the ATO.
Yeah, I mean, you wouldn't want to look unusual. I mean, if you're holding back invoices for 6 months, that would certainly arouse the auditors, and the people would be asking you why. And again, for people out there with rental properties, this is really nice. If you have a rental property and you need some sort of maintenance, why not get onto it now? Because if you can bring the deductions into this year, keeping tenants happy. I don't know how many landlords like doing that. Certainly with the rental crunch, that doesn't sound like too many. But the nice thing is you get a better deduction as a result. So that's good.
Yeah. Although you've got to be careful there if you're dealing with a painter, and you've got a rental property, you're looking for an early deduction. But if he's tuned into this podcast, he'll want to issue a later invoice. So,
but the smarter the person that's listening to Dollars and Making Sense, and they may not be listening. So there you go, ladies and gents. Yeah, you want to be maybe dealing with people that aren't listening to the podcast or watching the YouTube channel. Now, interestingly as well, and we covered this actually with Natasha previously on the Super Shows, you've got here, consider making after-tax contributions to your super fund. Be mindful of contribution caps. And also for the very high income earners for Div 293, a whole range of different palaver that goes on with that. And we always say this, you should seek financial advice. So I think that's a big one. Now, I wanted to also cover off with you today too, Frank, depreciation. We're starting, this once-off write-off asset thing. It's sounding like it's becoming a more popular feature of the tax landscape. What's happening there?
Well, it's whatever's happening, it's not happening quickly. It's part of a bill that's got a lot of other stuff in it, which isn't always the best way for the government to proceed. But the Senate has now amended the 20,000 cap to 30,000.
Oh, right.
They want to be even nicer to small businesses. I don't think the government will push that through in the House. So I suspect we'll land on 20,000 for the instant asset write-off threshold. And that was announced in last year's budget.
Now, I might clarify here for some of our listeners, because we actually got some feedback on this. This is not a check the government sends you, ladies and gentlemen. I had some tradies, ping me up and say, hey, when am I getting my money? It's like, no, that's not what's happening, guys. What's happening is you get a tax write-off. In other words, you have to spend your own money to get this write-off. And so they went, oh, okay. It sounded like, I went, yes, I know what it sounds like. I mean, Frank, do you get a lot of those kind of questions at the association?
Our members probably get the questions and they deal with them.
And I must admit, it's one of those things you're asking yourself, is that a trick question? They're trying to catch me out here. But it's like, in reality, and I saw this on some social media feeds where people were actually expecting to, they were saying, oh, we're getting a check. It's like, oh, no, you've misinterpreted.
It is a concession. You spend up to 20,000 for an item for a depreciating asset. Under the normal rules, you have to write that off over the life of the asset. So take 5 years, 10 years, whatever. Under the instant asset write-off rules, you've got small businesses. It's $20,000, which is not as generous as the temporary full expense that applied from October 2020 until the end of last year, June.
I think they were COVID. They were COVID provisions to try and help out. Yeah.
Yeah.
So, look, we're just about short on time now, but let's talk about some others very quickly. So, bad debts, obsolete stock, and bringing forward deductibles. So
Bad
this is
debts.
all about sort of
If you return income on an accruals basis, you have to pay tax on money that you haven't received yet. If you're on a cash basis, that's not a problem. But if you're on an accruals basis, and a lot of small businesses are, then you've got a receivable sitting in your balance sheet, and sometimes it's just a matter of admitting defeat, facing up to reality, write the thing off, but just check with your accountant whether you're doing it right.
So I just wanted to ask a question. Let's say you do write a bad debt off, and lo and behold, miracles happen, and next financial year they step up and say, "Hey, we've had some good times. We've got our money in. Sorry, we've been late. Here's the money." What happens then?
If you wrote the debt off and claimed a deduction in good faith, and the debt was on an objective basis, just not recoverable, you know, the guy that owes you the money's gone bankrupt, he's in jail, or he's left the country, whatever. Then, if miracles do happen and he strikes it lucky at the races or whatever, his grandmother leaves him a fortune, and he decides to pay you, then you stick it in your next return.
Okay, and you pay tax on it after that. That sounds great. That sounds great. Well, look, ladies and gentlemen, we're just about out of time. I would refer you to this article on the IFPA website by Frank. It's called Stage 3 Tax Cuts, a Tax Saving Option. Now, I would simply suggest to you, please have a read. There's some excellent suggestions there, Frank. It's always a pleasure to have you on the show, because I know some people think talking tax is boring, but it's only boring when you've got to pay too much. It's great when you get tax returns. So, ladies and gents, Frank, thanks so kindly for being on the show. And until next time when we start talking tax again, thanks for being on Dollars and Making Sense.
Be with you, Ray.